Hi guys, welcome back to Sakran. In this video, we are going to be discussing about game theory and its application by the Central Bank of Japan. September 2024, inflation is running at 3%. The Fed's target is 2%. Short-term interest rates are locked at 5.25% to 5.5%. That's the highest in 2 decades. Jerome Powell stands at the Jackson Hole podium and tells the world, "We are data dependent. We will not cut rates until inflation is convincingly under control." Bloomberg terminal screens flicker. Within 48 hours, the futures market are pricing in a 70% chance of a September rate cut. The market just called the Fed's bluff. This is game theory. Because central banks do not operate in a vacuum, they operate in a strategic environment with three other players: financial markets, commercial banks, and the governments, all of whom have their own incentives. And every single day, they are playing a game of signaling, credibility, and coordination. The question is, the question is not that the markets get it right. The question is, why did the central banks lose the ability to be believed? This is what we are going to be breaking down today. Central banks have two mandates: price stability and financial stability. Financial markets have one mandate: make money. Commercial banks have to remain solvent and maximize returns. Governments have to grow the economy and keep employment high. These do not align. When the Fed raises to fight inflation, it slows the economy, which hurts the government's growth targets. When market anticipates a rate cut, they front-run the central bank, effectively forcing its hand. When commercial banks hoard liquidity, they break the central bank's transmission mechanism. And when governments borrow excessively, they put the central bank in an impossible position. This is a multiplayer game theory with incomplete information. The question is, who has the strategic advantage? And the answer depends entirely on the credibility of the central bank. The Nobel Prize winning work of Kydland and Prescott, later extended by Barrow and Gordon, showed that even optimal policy plans are subjected to time inconsistency. What looks optimal today becomes suboptimal tomorrow, and without a credible commitment mechanism, central banks will always be tempted to renege on past promises. Let's start with the foundational insight. In 1977, Kydland and Prescott published a paper that would win them a Nobel Prize. They introduced the concept of time inconsistency. A policy that is optimal to announce today becomes suboptimal to actually execute tomorrow, because the circumstances have changed. The classic example is inflation. A central bank announces, "We will keep inflation at 2%. Everyone believes them. Workers accept moderate wage increases, firms set moderate prices, inflation stays low. But once the central bank has established credibility, it faces a temptation. What if they create a little surprise inflation? It would reduce the real value of government debt, boost employment temporarily, and look like a free lunch." The market, knowing this temptation, never believed the 2% commitment in the first place. So workers and firms designed higher wages and prices upfront. Inflation stays high, and the central bank ends up with the worst outcome: zero credibility and higher inflation. The conclusion by Kydland and Prescott was that a central bank needs a mechanism to bind its own hands: a legal mandate, a rigid inflation target, or operational independence. This is why modern central banks are independent. This is why the ECB has a treaty-level inflation target. This is why the Bank of England has a legally binding remit. But independence is not a light switch. It's fragile. It can be lost, often in a matter of weeks. Barrow and Gordon extended Kydland and Prescott's insight into a formal reputation model. In their framework, the central bank and private sector play an infinite repeated game. If the central bank builds a reputation for toughness, the private sector believes its announcement. Inflation expectations stay anchored, and everyone wins. But if the central bank cheats, if it creates a price inflation or it creates a short-term benefit that loses its reputation for multiple periods, the Nash equilibrium of this game is not the optimal one. Without a commitment technology, the central bank ends up producing higher inflation than it is announced. And the private sector, knowing this, builds that inflation into expectations. The result? An equilibrium where inflation is higher and welfare is lower. The only solution is credible commitment, a mechanism that makes cheating so costly that the central banks will never ever do it. The mechanism for this is central bank independence. But here is the twist that most commentators miss. Independence is not a structural fact. It is a strategic choice made by the government, and governments can withdraw it the moment it becomes politically inconvenient. The second major framework in monetary policy are also known as signaling games. The central bank is a signal sender, and the financial markets are signal receivers. The central bank uses interest rate decisions, forward guidance, and open market operations to influence market expectations and inflation forecasts. The problem is asymmetric information. The central bank has more information about its reaction function and future policy path than the market does. But the market knows that the central bank knows this. So the market plays a signaling game. They interpret every word, every pause, every dot on the summary of economic projections. In a well-functioning signal regime, the central bank sends a clear signal. We will cut rates in September, and the markets believe it. Rates adjust preemptively. Financial conditions ease without actual policy action. But when the central bank signal is inconsistent, that we are data dependent, followed by we see downside risks to unemployment, followed by actual rate cuts, the market stops believing. Where the Fed is concerned, a signaling breakdown has been increasingly observable. Because when the central bank signals a rate cut, even as inflation expectations are doubling, the market no longer knows where the central bank is seeing something hidden in the data or whether political pressure has compromised policy objectivity. The result is policy uncertainty, a sharp rise in the economic policy uncertainty index, and uncertainty is the enemy of both stability and growth. The third framework is known as coordination games. The most relevant is the stag hunt, which describes the relation between a central bank and a commercial bank in a liquidity crisis. In the stag hunt, there are two Nash equilibria. A good equilibrium is all banks coordinate with the central bank, liquidity flows normally, no defaults. A bad equilibrium is where banks hoard cash, refuse to lend, and a liquidity crisis turns into a solvency crisis. The central bank's job is to force the coordinated equilibrium by providing unlimited liquidity, what we call the lender of last resort function. But here is the game theory inside. The central bank's ability to force coordination depends entirely on its credibility. If the banks believe the central bank will intervene early and aggressively, they coordinate. If they believe the central bank will hesitate or act too late, they defect. This is exactly the Bank of England situation in September 2022. The fourth and the final framework is the currency attack game. In a fixed or managed exchange rate regime, the central bank plays a one-shot game with currency speculators. The speculators' payoff depends on whether the central bank will defend the peg. If the central bank is committed, attacking is costly. If the central bank is weak, attacking is profitable. Game theory shows that the speculator's decision to attack does not depend solely on the economic fundamentals. It depends on the speculator's beliefs and how many other speculators will attack. This is a coordination game among speculators, and central bank credibility is the deciding factor. The 1992 attack on the pound is the textbook case. Now, let us all see four frameworks in action. In the single most dramatic central bank game of the last decade, the Bank of Japan's yield curve control and the collapse of the yen carry trade. Let me tell you about a central bank that walked into a game theory trap and almost lost. From 2016 until March 2024, the Bank of Japan ran yield curve control. It capped the 10-year Japanese government bond yield at 0%, forcing long-term interest rates to stay near zero. As global inflation surged, the Fed hiked rates to 5.25% and between 5.5%. The interest rate differential between Japan and the United States ballooned to over 500 basis points, and the market saw an opportunity. Hedge funds and institutional investors began the largest yen carry trade in history. Borrow yen at 0% interest, sell it for dollars, buy US treasuries at 5%, and pocket the spread. Risk-free profit. But what is risk-free for a hedge fund is a nightmare for central bank. Every yen sold pushed the currency lower. By 2024, the yen had depreciated past 160 against the dollar. That was a 34-year low, and the game had just begun. Perspective of game theory, the Bank of Japan was playing a signaling game with the market, and it was losing badly. The Bank of Japan repeatedly said, yield curve control is sustainable. We will defend the 0.5% cap. The market responded by pushing the 10-year JGB yields to 0.55%, then 0.6%, then 0.75%, forcing the Bank of Japan to intervene and hammer rates back down each time. But here is the losing move. Each time the BOJ intervened, it had to buy massive quantities of government bonds. That expanded its balance sheet, that loosened the monetary conditions, that debased the yen further. And a weaker yen meant carry traders made even more money shorting the currency. The market was not just attacking the Bank of Japan, it was forcing the Bank of Japan to fund its own attack. The most telling signal was the spread between the 10-year JGBs and the 10-year swaps. Swaps traded up to 1%, a full 50 basis point above the Bank of Japan official's YCC limit. This gap was not a pricing error, it was the market's collective statement. We do not believe in you. In classic signaling game theory, the central bank is the signal sender. When the receiver stops believing the signal, the game collapses into the pooling equilibrium, where the market assumes the central bank will always renege and the price itself accordingly. By 2024, the currency attack game had reached the full force. This was the same structure as George Soros' 1992 attack on the pound. In September 1992, Soros and other traders sold sterling short against the Deutsche Mark, betting the Bank of England could not raise interest rates to defend the currency while the UK's economy was in recession. The Bank of England intervened furiously. It made statements it was forced to retract days later. Sterling was ejected from the ERM, and Soros reportedly made over $1 billion. The BOJ faced the same dynamics. The exchange rate had reached levels that required intervention. Japan stepped up into the currency market 4 times in 2024, spending nearly $100 billion to prop up the yen. In early 2025, it intervened again, spending an estimated $34.5 billion in a single operation to buy $5.4 trillion yen and trigger a 230 PIP move to 1555.5. The interventions provided a short-term relief, but they did not change the fundamental game. As long as Japan's interest rates stayed near zero while the US rates remained high, the yen would continue to be the world's cheapest funding currency, and every intervention merely gave the carry traders a better entry price. The BOJ also suffered a coordination failure. The stag hunt reversed. In a normal coordination game, the central bank provides liquidity and the banks cooperate. But the BOJ was not coordinating with the market, it was fighting it. Each month, the BOJ bought bonds to defend YCC, and each month the currency weakened, giving carry traders more incentive to sell the yen. The trap was self-reinforcing. The Bank of Japan's balance sheet had expanded to roughly 130% of Japan's GDP, the largest of any major central bank in history. Every bond purchase was a stimulative measure that weakened the currency, and a weaker currency pushed up import prices. Japan imports nearly all its food, industrial goods, and energy. The contradiction was impossible. The BOJ could control either its interest rate, the internal price of money, or its exchange rate. The external price of money, but it could not control both. In March 2024, the Bank of Japan did what game theory said it would eventually have to do. It surrendered. The Bank of Japan explicitly judged that its long-standing framework of quantitative and qualitative easing with yield curve control and negative rates had fulfilled their roles. It shifted to guiding a short-term policy rate at around 0 to 0.1% and abandoned the YCC cap entirely. Negative interest rates, an experiment that lasted 8 years, finally ended. The market reaction was instantaneous and brutal. The yen, which had been depreciating for 10 years because of the BOJ's ultra-loose policy, began to appreciate rapidly. The Japanese 10-year government bond yields surged to 1.95%, an 18-year high up from the 1.1% at the start of 2025. The yen carry trade, the largest structural short position in global markets, began to unwind. The Nikkei 225 plummeted 12% in a single day, dragging global equities down with it. Global markets experienced contagion because yen funded carry trades had finance positions in everything from emerging market bonds to US tech stocks. And when those trades were forcibly closed, everything sold off simultaneously. So, what was the final score of this multi-year game? The Bank of Japan spent approximately $135 billion defending a policy that it ultimately abandoned. Hedge fund and investors who were long the carry trade suffered catastrophic losses when the yen appreciated without warning. Japanese stocks saw the Nikkei 225 fall 12% in a single session, and the global markets followed. The BOJ's credibility, it was severely damaged. The market now knows that the BOJ cannot credibly commit to any exchange rate or yield target if the economic costs become too high. The knowledge will be priced into every future policy announcement for years. In game theory terms, the BOJ played a signaling game it could not win, a currency attack game it was structurally incapable of defending, a coordination game with a market that refused to cooperate, and it lost all three simultaneously. Let's be clear, central banks can also win these games. Paul Volcker's Federal Reserve is the classic example. In 1979, Volcker announced that the Fed would break inflation regardless of the unemployment costs. He raised the rates to 20%. The market initially doubted, but Volcker did not blink. He did not send mixed signals, he did not pre-announce cuts. After 2 years, the market believed. And once the market believed, inflation fell without raising unemployment further. The so-called sacrifice ratio was much lower than anyone expected. Walker won the game because his commitments was credible. He had tied his own hands. Central banks lose when credibility breaks down. The BOJ from 2020 to 2024 demonstrated how time inconsistency in monetary policy, promising to keep rates low while the rest of the world was raising them, creates a structural vulnerability to currency attacks. The Bank of England in 1992 demonstrated how a central bank fighting a currency attack without credible commitment mechanism will lose, and will lose publicly in a way that damages its reputation for a generation. As we are witnessing now, the Federal Reserve risks a signaling breakdown of its own. And when the Fed signals a rate cut, even as the inflation expectations climb from 3% to 6%, the market does not know whether the Fed is seeing something hidden in the data or whether the political pressure has compromised policy objectivity. Some analysts have described this as the Fed playing poker with its cards face up on the table, providing a valuable gift to the financial sector. Here is what most people miss about the central bank game theory. Almost every model assumes the central bank is a unitary actor, a single decision maker with a fixed reaction function. But the Federal Open Market Committee has 12 voting members, each with different views. The Bank of Japan's 9-member policy board has produced consistent dissent on YCC for years. When Powell says the Fed is data dependent, he's not just signaling to the market, he's signaling to the other members of the FOMC and holding a fragile coalition together. The internal game is almost never discussed in public, but it explains why central bank signals are often contradictory. There is no single central bank view, there is only the median view of a committee. And the median has a tendency to move with data. The result is intentional ambiguity. Central banks deliberately obscure the reaction functions because committing to a specific policy path would expose internal divisions. The market, which knows this ambiguity is intentional, responds by pricing in the probability of policy shifts. And that probability, not the central bank's actual word, becomes the de facto signal. This is not efficient. This is not inefficient. It's the equilibrium result of the internal committee game that sits underneath the public signaling game. The real rule of central bank game theory is this. Central banks do not control markets. They influence expectations. And expectations are formed rationally. They're formed by the players who know the central bank's incentives, constraints, and the history of credibility. If the market believes the central bank, small actions have large effects. If the market does not believe the central banks, even massive interventions become meaningless. This is why the BOJ spent $135 billion defending the yen without stopping the slide. This is why the Bank of England spent billions in defending the pound before Black Wednesday. This is why the Fed's forward guidance program has become less effective as inflation expectations have decoupled from policy announcements. The only thing that matters is whether the market believes you. If it does not, you have already lost before you have taken a single action. Every time a central banker speaks, ask one question. Does the market have a reason to believe them? If the answer is yes, the game proceeds efficiently. Policy signals transmit, financial conditions adjust, and there is no crisis. If the answer is no, if the central bank has a history of time inconsistency or signaling breakdown or coordination failure, then the game proceeds inefficiently. The market prices based on what the central bank will actually do and not on what it says it will do. That gap between word and expectations is where the volatility lives. It is where George Soros made $1 billion in 1992. It is where carry traders lost billions in 2024. It is where central banks lose their credibility and where eventually the governments lose their patience. Compress everything into 3 bullet points. The core problem. Kydland and Prescott's Nobel winning insight. The policy that is optimal to announce today becomes suboptimal to execute tomorrow. Central banks need credible commitment mechanisms, usually independence and inflation targeting to avoid this trap. Key players. 4 strategic actors with misaligned incentives, central banks fighting inflation and maintaining stability, markets seeking profit, commercial banks managing liquidity, and governments pursuing growth and employment. Outcome when credibility fails. Signaling breakdown leads to currency attacks, costly interventions, and ultimately a default of the policy regime. As the Bank of Japan discovered when it abandoned the yield curve control after spending $135 billion defending an unsustainable cap. In 1992, the Bank of England lost this game. In 2024, it was Japan's time. The question is not whether a central bank will face this game. The question is whether they will lose with grace or be forced out in a crisis. Game theory is not an academic exercise. It is a hidden operating system of global monetary policy.